Would you like to produce consistent monthly cash income in your trading account? In this video, our head of options trading and my friend Seth teaches you exactly how to do that. I'm Jeff Holden, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn.
Hi, I'm Seth Freudberg. I'm the head options trader here at S&B Capital in Manhattan. And this week we wanted to share with you a talk that I gave at the Money Show in Orlando last week. We figured, hey, might as well share these points and this knowledge with our YouTube subscribers and followers. So let's go ahead and dive in. And in today's talk, you're going to be discovering that there's an asset that actually pays you to put in a low ball bid for that asset. It doesn't sound possible, but you'll understand in a minute. And then secondly, we're going to talk about a really simple way to earn monthly cash income from your account every single month through options trading. So let's dive into the way all this works. Let me ask you a question. If you put in a low ball bid for a house that you're interested in buying, does the realtor hand you a check for putting that low ball bid in? Has that ever happened to you in a real estate transaction? I doubt it. Similarly, when you go into a car dealership and they quote you the price for the car and you put in a low ball bid for that car, right? Does the dealer write you a check for just submitting that low ball bid? Well, of course not, right? But how about stock? If you are trading stock, if you're interested in a particular stock, and you actually put in a bid for that stock below that stock's current trading price, is the market going to pay you for doing that? And the answer in this case is yes. And that's what we're going to be sharing with you in today's workshop. So let's talk about call options and put options first, because you need to understand how they work before you can understand why I mean that the market will pay you to put in a bid for a stock. So let's start with call options. When you buy a call option, you're paying for the right to buy 100 shares of stock that you own at what's called the strike price of that call option, the strike price you choose. And we'll show you an example shortly. At any time before that right expires. And the cost of that right is what is called a premium. When you sell a call option, you're obligated to sell 100 shares of the stock you own at the strike price of that call option at any time before that call option expires, regardless of how high the stock's price has gone. And for doing this, you get a cash payment, a premium for effectively putting a cap on how much you can make on that stock. On the day that that call expires, if the stock closes below the call strike price, the call option expires worthless, and you get to just pocket the premium you received for selling that call option. Now, how about a put option? Well, when you buy a put option, you're basically just doing the opposite of call options. You're buying the right to sell 100 shares of a stock you own at the strike price of that put option, which is a strike price that you choose, at any time before that right expires. The cost of this right, just like with the call, is called an options premium. And this puts a floor on your stock's value. So if you're a put buyer and you buy a put, you are basically buying insurance on the price of that stock. But when you sell a put option, you're obligated to buy 100 shares of a stock at the strike price of that put option at any time before that put option expires, regardless of how low the stock's price has gone. And for doing this, you receive a cash payment. You get a payment for effectively bidding on a stock at a price that you choose. And that's why I say that the market actually will pay you for putting in a bid below where a stock is trading. Now, if on the day the put option expires, the stock closes above that put strike price, the put option expires worthless, and you just pocket the premium you received when you first sold that put. Now we'll get into how this information, the fact that if you sell a put option, the market will pay you for selling that put option. And if you sell that put option below where the stock is trading, then you are essentially getting paid for putting in a bid for that stock below where it's trading. The cash secured put strategy leverages this property of put options. So let's give you an example. Amazon stock on August 1st of 2024 was trading at 188.07. Okay, so let's say that you went to an options chain on your broker platform. You pulled up an option that expires on August 30th, about a month later, and you saw that on that day, on August 1st, 2024, the 185 put, which is the put that's a little bit more than 3 points below where Amazon was trading that day, which was up above 188. The 185 put was trading for 698. If you sold that put, what exactly would happen with your account? The price was 698, but each put options contract represents 100 shares of the stock that you are talking about. And so you got to multiply that price by 100. And so in your account, your broker would actually deposit $698 because you just sold a put which was priced accordingly. And by the way, just so you know, if you were to do this trade, you'd have to have $18,500 in your account because it's the 185 put. You'd have to have $18,500 in your account so that if you end up getting assigned those shares, then you will have the cash to pay for those. We're going to move now to August 30th, and you're going to see that Amazon closed at 178.5. And remember, we sold the 185 put. So what happens? Well, Amazon closed at 178.5 on August 30th. Your cash secured put was located at 185, just like we told you. Amazon closes below that strike price by 6.5 points, as you can see. The broker will execute your purchase of 100 shares of Amazon for 185 per share. So you'll have paid 18.5. And remember, we mentioned you're going to need to have 18.5 handy should this happen. So let's say on that exact same day, you decided to do this transaction all over again. So you went out about 30 days, this time to September 27th. And with Amazon trading at 178.5, you sold the 175 put. And that was trading for 305 that day. Same kind of math. The 305 times 100 comes to $305, obviously. So that's the amount of cash that your broker is going to deposit in your account. And you're going to need 17.5 in cash available should this put get assigned. So we're going to move now to the day that put expires, the second put, and you'll see that Amazon rallied to 187.97 by that time. And so it closed at 187.97 on that day. And so what happens? Well, it closed at 187.97. The cash secured put was located at 175. So Amazon closed almost 13 points above the strike price. So that option expires worthless and goes to options heaven. In other words, the option simply disappears. It evaporates, it goes nowhere, and you get to keep the $305, as you can see from this profit calculation. Pretty simple calculation. You got in $305. $0 needed to be expended in any way to close the put. It simply just died, and therefore you keep the $305. There's only two possible outcomes with the cash secured put. The stock's price closes below the put strike price and you're assigned the shares, like in that first example, or the stock's price closes above the put strike price and you just pocket the premium you got initially. Now that you've got the basic concepts down, we can go ahead and talk about a campaign of cash secured puts. First of all, a campaign on cash secured puts can't just be done on any old stock. It can only be on stocks where you have a long-term bullish outlook. And the reason is because once you get assigned the shares, it's not clear how long you're going to be owning those shares. And you'll understand that in a minute. but just accept that this is a very poor strategy to use unless you have a basic long-term bullishness on any particular stock. Think about it this way. You should only do this on a stock that you would love to own for the long term, especially if you can buy it at a cheaper price below where the stock is trading currently. Speaking of bullish stocks, I'd like to direct your attention to the SPY, which of course is the S&P 500 ETF. And over the last 25 years, the SPY has appreciated 422%. If you accept that the world's economy will continue to grow, it's a pretty comfortable bet that the SPY is a good long-term investment. So this would be an example of the kind of stock that you might want to engage in a campaign of cash secured puts on. Let's take an example going back over about the last year so you can understand how a campaign of cash secured puts would work. So September 15th, 2023, a little bit more than a year ago, the SPY closed at 443.38. So let's say that day we pulled up an options chain expiring about a month later. This time it was October 20th. And we went ahead and sold two SPY 443 puts. So SPY was trading at 443.38. We're selling two SPY 443 puts, a little bit below where the stock is trading, and they're trading for 547. Just like we showed you in the previous example, let's take a look at how this plays out. So how much cash are we going to get in by selling those two 443 puts? Well, they're priced at 547. Remember, we multiply them by 100 because each options contract represents 100 shares of stock. And we sold two of them. You got to multiply it by 2, and you end up with a $1,094 cash deposit into your account. Just like we said with Amazon, you're going to need the cash necessary to buy the shares if these shares get assigned, and so you need 88.6 in your account for this transaction. Okay. SPY closed on October 20th, the day these options expired, 421.19, down. So what's the outcome? Well, SPY closed more than 21 points below its strike price of 443. The SPY shares were therefore assigned. Remember, you were selling the right for the put buyer to put his shares to you. So you're going to get those shares, and you'll receive 200 shares of SPY in your account, and you'll have paid $443 per share. You pocket that $1,094 you got for selling this right in the first place. You always get to keep that. And so let's start keeping a little bit of a scorecard of how this is going. The October trade, when you enter into a trade, you categorize it by when it expired. All right, so this first trade expired in October 2023. We got $1,094 in initial positive cash flow, and we were assigned those 200 shares of SPY. Once you are assigned the shares in this campaign, the next thing that we do is to sell call options against that. Notice that for the November expiration, which expires a month later, we've sold two 443 calls. Now, why did we pick 443? Does that number sound familiar to you at all? Well, it should, because 443 was the price we paid for those SPY shares that we now own, and that's because we had sold that 443 put. So if we sell a 443 call and the stock rallies and gets past 443, then our shares are going to be called away from us at 443. Meaning, if that were to occur, it may occur, it may not occur, but if it does occur, we're going to have bought shares for 443 and then subsequently sold them for 443, meaning we neither experience a realized gain or a realized loss. Those shares just go away and they zero out our original purchase. We simply pocket the call premium that we sold for the November expiration, which we're doing in this case. And this whole approach is what's called the wheel strategy. You sell cash secured puts. If the shares get assigned as a result of your selling that put, you then start getting income through selling calls against those shares until the stock bounces. Those shares get assigned away from you and you start all over again. And we'll give you examples of all that. We sold the 443 calls. We received $1.12 for those. So if you look at the math, that ends up being $224 of cash deposited into our account. Okay? We got 200 shares of SPY. We've sold 2 calls at 443. So let's move to November 17th. And as you can see, SPY rallied and it went to 450.79. And so what does that mean? What's the outcome? Well, SPY closed more than 7 points above the call strike price of 443. And so the shares were assigned away at 443. We bought them for 443 initially because that's what our put obligation was. And now we sold them at 443 because that's what our call obligation was. So there was no realized gain, no realized loss from the SPY share ownership. That SPY share ownership was just a temporary thing, and now it's actually gone away. So, of course, you get to pocket that $224 of cash that you got for selling the 2 calls. So we're going to update our scorecard here, and you'll see that the scorecard is now showing an additional $224 of cash that we earned in the month of November. Let's now move to the December trade. The November trade's over. Our capital's been freed up. Our shares are taken away. We've now got the cash back into our account. We can simply resume the selling of the puts. So with SPY trading at 450.79, we sell the 450 puts. As a result, we get in $1,038 of cash flow into our account for doing that because they were priced at 519, and you can see from the math that results in $1,038 in cash. We have $90,000 necessary in our account to execute this trade, a little bit more because the stock's going up, and we now have the 450 puts in play, so we've got to have $90,000 should those shares get assigned. So let's see the outcome of this trade. And as you can see, on December 15th, the stock rallied further up to 469.33. And so let's take a look at what happens. The stock closed 19 points above our strike price of 450. The puts expired worthless. And we just pocket that $1,038 of cash from selling those 2 443 puts. So let's go ahead and update our scorecard one more time. And you can see the $1,038 we have received and have profited from for the December trade because those options expired worthless. At this point, it's just rinse and repeat. You've now seen examples of selling the put, having it expire worthless, selling the put, having it get assigned, and then selling calls against that, having those get assigned, and that results in you're being back into the position of simply selling the puts. And that's why it is known as the wheel strategy. If you wanted to do a full campaign of this, you just do it every month. Each month you enter a new trade, immediately entering the next month's trade once the previous trade ends. You sell puts each month right below SPY's price. In other words, they're called essentially at the money puts until SPY closes below the put strike price, at which point 100 shares of SPY will be assigned to you per lot. When those shares get assigned, sell calls against them, just like we showed you, at the strike price the puts were assigned. That guarantees no realized loss when the shares eventually are called away. And when they do get called away, you simply resume selling at the money puts. It's as simple as that. It would take a very long time to go through the entire year and show you what happened every year, every month. But I think by now it's going to be pretty easy for you to understand what happened every month simply by looking at the outcome of the remaining trades. So we went over the October, November, December trades already. The January trade, we sold the puts, SPY bounced some more, and so we just made this $960 from those cash secured puts we sold that month. The February, same thing. We made $1,000. SPY bounced above the price that we sold those puts, And so we made another $1,000. In March, same thing. We sold the puts, SPY bounced. We just pocket $1,174 for that month. Now in April, we sold the puts for $12.88, but this market sold off and the SPY sold off, and therefore the put options were signed, and we had acquired the 200 shares of SPY. In May, we sold calls. So for that May trade, we sold calls against those puts at the strike price that we acquired the shares. In other words, the previous month's put strike price. We received $746 for selling those calls. SPY bounced past that strike price, so our shares were called away. Our call disappears. We keep the $746 in cash. Now we're back in all cash into our account. The June trade, options expired, worthless again. We had sold puts. We received $11.72 for those. SPY bounced. Those puts went out worthless. So we'll move to the July trade. The July trade, same thing. $1,114 in cash received. SPY bounced. Those put options expired worthless. We just pocketed the $11.14. August, once again, SPY bounced again. $14.01 in put premium this time. We just get to pocket that. And then finally in September, exact same thing. $15.68 was the amount we received for the puts. SPY bounced again, enough to clear the expiration price of the puts, and therefore we simply pocketed the $15.68. So for the whole year, we made $12,781, so about $1,000 a month on average capital of $99,650. You can see now, whether you're selling puts or you're selling calls, you're making cash every month. And that's the whole concept behind this campaign. All right, now there's one other very important point I want to make to you, and that is the money market treasury yields over the last 3 years are exemplified on this chart. And you may wonder why I'm sharing this with you, but you'll see that in a minute. Back in 2021, you could see treasury yields were essentially zero. Money market treasury yields were close to zero. There's no point in investing in money market treasury yields at that point, basically. Okay? But as inflation began to climb and the Fed began to fight that inflation, it did so by raising interest rates. So that process started in May of 2022. And by January 2023, the money market rates had exceeded 4%. And by later in that year, they had exceeded 5%. Okay? Recently, they have dropped very slightly, but they are still very healthy compared to zero, which is what they were prior to that. Now, why am I even mentioning money market yields out of the blue? Well, the wheel strategy, which we've just shared with you, it has certain pros and cons. It provides you with cash flow every single month, either through selling the cash secured puts or covered calls. But in months where puts are sold, your cash can earn money market rates, which right now in October 2024 are a little bit below 4.7%. Cash secured puts will generally outperform the market in flat or down markets. So in a flat or down market, you're actually better off implementing the wheel strategy, generally speaking, than being in the equity markets. Cash secured puts will generally underperform the market, however, in very bullish markets. Okay, so you're giving up something by getting into this strategy. It will always produce cash flow. Whether that cash flow will compare favorably to being in the equity markets depends upon the market, and that's why I just made the last two comments. Regardless, though, this strategy will always produce monthly cash flow. And so what I'd like you to take away from today's video is that the wheel strategy essentially assures you that you will be able to yield some monthly income from your account every month. It's going to vary depending upon whether you're selling puts, how close those puts are to the market price of the stock you're selling the puts on. And then, of course, if those puts get assigned, you can sell calls against those, as we described in the wheel strategy, and you can make your cash income that way. Either way, you'll be able to derive cash income from your account through the wheel strategy.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.